How are you going to become a real estate mogul? How are you going to become a real estate, investor? And the way to become a real estate investor is simply by investing in property. Hello friends, welcome back to my channel, The Bulletproof Life. If you are new, my name is Ronke Odewumi and I'm delighted to have you here. Today, I'm going to be sharing about how to invest in the property market without hassle, how to get into real estate, specifically in the UK, without any stress, without you undergoing any training or running after anybody to show you how to become a buy-to-let landlord. That is what I'm going to be sharing with you today. But before we get into that, can I ask you, have you subscribed to my channel? If you haven't, please do it by pressing the red button on your right. Don't forget to press the bell so you can get notifications every time I share a new video. So let's get right into today's video. How are you going to become a real estate mogul? How are you going to become a real estate, investor? And the way to become a real estate investor is simply by investing in property. Now, the normal route that people go down is to buy property and become a landlord. So you save up, put down a deposit on a property, and then you buy it, become a landlord, and get rental income. At the same time, the value of the property grows, and so you're building wealth. Now, this comes with a lot of hassles, and the hassle that it comes with includes tenant management. It includes all the hoops that have been put in place now by the government in the UK to make sure that you're treating your tenants right, which is good, but also to make sure that you're paying the right amount of tax. And that tax has grown over the years, especially if you're a high income earner. The tax is quite high. You have to pay tax on your rental income even before you take out the mortgage on that property, and that has really eaten into the profit for a lot of landlords in the UK. There are a lot of rules around HMOs, what you can do with the property, how you can rent it out, how you can relate with tenants, what you need to do every year, all the forms, all the things you need to do, all the requirements. Is a lot, and it discourages a lot of people. Also, for you to become a landlord, you need money. You need a decent amount of money. For you to buy even a property worth £100,000, you need about £20,000 because you need a 20% deposit. So that also is something that has become a barrier for a lot of people who are looking to grow wealth in the property space, in the real estate space. You need to save up money, you need to have money, and then you think about the fact that you have to manage tenants. And so a lot of people have stayed away from the real estate market as a way of growing wealth. Now today, I have a secret to share with you. You can invest in real estate without actually buying property. You can invest in the real estate market and avoid tenant stress, tenant wahala. You can avoid it. You can stay away from all of it and invest in property and sit back and grow wealth in that industry without stress. So how can you do it? Drum roll. You can invest in the real estate market, you can invest in the property market through something called REITs. You're looking at me like, what's REITs now? Can you going to tell us? Yes, I'm going to tell you. REITs is an abbreviation, and it actually means Real Estate Investment Trust. So, what is a REIT? What is a real estate investment trust? A real estate investment trust is a property investment company. It's a company that has been set up for the whole purpose of investing in property. Now, the thing with REITs is that they are traded on the stock exchange exactly like other companies that you would invest in. Because they are traded on the stock exchange, you can invest in these companies the same way you would invest in a technology company, a pharma, a food company, and so on. And that is how you invest in real estate, by investing in a REIT. You can invest £1,000, £500, £2,000. You don't have to wait for a large deposit to get into that market. You can simply invest whatever amount you have into a REIT, and boom, you are invested in whatever that REIT is invested in. REITs were introduced in the UK in 2007, and since then, most of the UK's largest property companies have converted into REITs, allowing you to invest in them and then invest in property. Names like British Land and Land Security. To qualify as a REIT, at least 75% of the profits of these companies must come from property rental, and 75% of the company's assets must be involved in the rental business. REITs are also required to pay out 90% of their rental income to their investors. So they are basically buying property on your behalf and then paying you rental income, and you don't have to do any of the rental work. You don't have to look for the tenants. You don't have to manage the tenants. You don't have to do anything like that. These companies do everything for you. They do all of the heavy lifting, and they have to return 90% of their rental income back to you. That is the benefit of you investing in REITs. REITs are the way for you to invest in the property market without you actually buying property and managing it by yourself, or without you actually saving up a deposit and then using that to invest in property, searching for the property, making sure it's in the right area, making sure that it's livable, having to do all the repair work. None of that is your concern. With a REIT, you simply invest in the REIT. You simply buy the shares of the real estate investment trust, the same way you will buy the shares of any other company on the stock exchange. As you can imagine, the regulations required of REITs are very strict. The 75% requirement for them to be in rental, the 90% payout to investors. These are very strict regulations that REITs have to abide by for them to operate. Now, in exchange for operating within these relatively strict rules and to encourage investment in the UK real estate sector, REITs don't pay corporation or capital gains tax. Let me repeat that. REITs don't pay corporation or capital gains tax. It means you are not paying corporation or capital gains tax on your property investments. You are just investing in property and collecting all the benefits. This special tax arrangement means that dividends are only assessed once for tax when they get to you. So the REITs are not paying capital gains tax. They are not paying corporation tax. You are getting your money straight up. Once you invest in the property market through a REIT, you are likely to experience steady income because their tenants are long-term and the rental income is stable. In addition to that, some REITs are able to enforce regular rent reviews on their tenants, which means that you as an investor will also enjoy steady income growth. So how do you evaluate REITs? How do you evaluate their net asset value? REIT returns to investors come in two parts: dividends and change in net asset value. Dividends that they pay you because profit and revenue, and then changes in net asset value because the property increases in value. Net asset value represents the value of the asset owned by the REIT. So for example, if the assets owned by the REIT, less any debts, are worth £1 million and there are 1 million shares in issue, the net asset value per share is £1. Now, if the value of the property increases either through market movements or development activity, the REIT's net asset value will grow. This means that your asset value will grow. Also, if your REIT is invested in a sector or in a particularly popular area, demand might push the share price up. The share price can rise above the net asset value as well. The same process in reverse might mean that the value of your REIT is pushed down to a discount. Nevertheless, REITs are a great opportunity to grow wealth in the property sector without hassles. REITs with a long track record of growing net asset value per share often trade at a greater premium and are worth extra attention from investors. As a general rule though, REIT share prices have tended to move in line with the net asset value. So the more your property or assets increases in value, the more their share price also increases in value. Now, since REITs have to pay out most of their income to investors, it's hard for them to build up enough capital to reinvest in new property from their profits. So for companies looking to expand, that leaves two means of funding their growth: selling new shares or taking on debt. The level of debt in a REIT is something you as an investor should keep a close eye on. REIT debt is usually measured in relation to the net asset value through what's called loan to value ratio. This is something you're familiar with if you have a mortgage. The proportion of the property portfolio that is funded by borrowing is what is called a loan to value ratio. Now, a higher ratio means more leverage. If the company has, more ownership of the property, they have more leverage. Using debt can stop investors having to stump up more cash or risk being diluted, as they would be if the company chooses to sell new shares. However, it does bring an extra level of risk. Because property prices are cyclical, property values can change very quickly, which is another reason why it's better for you to be doing it through a REIT than doing it by yourself. Now, a REIT with a high level of debt can quickly find itself in trouble as loan to value shoots up, especially if a downtown also eats rental income. It can reduce its ability to service or repay its debt. Now, I've talked to you about REITs, I've talked to you about the benefits of REIT, I've talked to you about what you need to watch out for. I've talked to you about their debts and their reliability on rental income. I've talked about how you can get steady income growth from REITs, and now you know all of that. There are over 50 REITs listed on the London Stock Exchange. You have a lot of options, and I'm going to make a video where I will talk about the 50 REITs listed on the stock exchange, which are collectively worth over $70 billion. I'm going to talk about them. I'm going to give you names. In another video, I'm going to give you a comprehensive list of the REITs you can invest in, so that you can start investing in real estate without actually buying property. I mentioned earlier, if you were watching the video, that there is British Land, there is Land Securities. These are really big REITs in the UK. They are invested in Canada Water, Canary Wharf, all of the big places, and you can jump into that you can jump into that investment space by simply buying the shares of the real estate investment trust. If you have watched my other videos, I've talked about investment platforms where you can buy shares, where you can buy ETFs and so on. You can also buy real estate investment trust on these investment platforms. I hope you've enjoyed this video. I hope you are ready to get into the property market. I hope you are ready to do your thing. I hope you are ready to stop holding on and saying, I'm going to save up a deposit, because now you can get into the property market easy peasy lemon squeezy. It's your girl. I've promised you that this year I'm going to bring you investments. I'm going to bring you things that will help you grow wealth, and this is the first part of it. I hope you've enjoyed this video. If you have, please press like, smash the like button. If you haven't subscribed, come on darling, please subscribe to this channel. I want to see you every week.